yourselves. Sorry, unmute yourselves. So great. So we'll shortly begin the session. Just let's wait for a few more participants to join. And see this session overall. Before we start this session, let me give you a brief gist of the session. We will be moreover covering single candlestick patterns in this session, and we'll see how these patterns are actually useful in identifying trade opportunities, and how these patterns can be useful in identifying different trade setups, and how see basically many of these candlestick patterns you must have already seen quite a lot, and when but you might not be aware of their logics and all the details and all the technicalities of these candlestick patterns. So we'll briefly discuss about those patterns, and at the end of the session we will discuss a very interesting trading story. We'll discuss a legendary trading story which actually happened in the real markets. It is that type of story which people actually dream of. So we'll discuss about those things as well. So let us quickly begin with the session. The session's name is Money Making Candlesticks. By candlesticks, I mean Japanese candlesticks, or it is a charting type which is actually used to determine or predict which is very common in technical analysis, and it is actually used to determine or predict the prices of the underlying asset. And there are various types of tools and multiple things involved in technical analysis, and in this particular session we will only be covering the single candlestick patterns. So let us quickly begin with the session. So before we start the session, let me give you a brief overview of the session. So the single candlestick patterns are basically formed by one candle and are generated based on one day's trading action. And whenever you look at these candles, you have to wait for the day's end to come to a conclusion. You can use these candles on different time frames as well, but mainly we will discuss all the logics based on daily chart. So, and you can use these logics and the analogies in other time frames as well, as long as you are able to grasp the idea behind the candlestick patterns. And see, the longer the candlestick pattern on a particular day is, the more intense buying selling action happened for that day, and shorter candles mean weaker action, or the action was subdued for the day. So trades based on these candlestick patterns actually turn out to be very profitable if you are able to identify and execute these properly. Then these turn out to be very profitable. So we will be discussing all these few common patterns, and the logic and ideology behind those patterns, and how the bulls and bears of the markets take their position and enter the markets based on these. You can look at these candlestick patterns and actually identify the entry and exit of bulls and bears. So the beauty of these patterns is that these patterns can be used on any chart. It can be used on charts of a stock, charts of a currency, charts of a commodity, anywhere. So this is the beauty of these candlestick patterns. So let us quickly begin with the first candlestick pattern. So the first before we start actually candlestick patterns, let us first look what is a candlestick. So, candlestick is nothing but a particular chart type where you find these types of drawings on a particular chart. So, what indicates is, let's suppose there are two types of basic candles: a red candle or a green candle. So, in a red candle, basically, there are four important points to note: the high, close, open, and low. So, every candle, the colorful part of the candle is basically, you will find the colorful part of the candle is basically more or less the body. It is called the body of the candle. And if it is a red candle, then obviously the price has I think it is, the color here is marked opposite. So basically, when it is a red candle, the opening price is higher and the closing price is lower. And similarly, in case of a green candle, the opening price is lower and the closing price is higher. In this figure, in this chart, I think it has been marked opposite. So kindly ignore that. And now let us move to actually the candlestick patterns. So, like we discussed, that when the candles are long, then the intensity of buying and selling actions that happened on that day is more intense. And in case of shorter candles, the intensity of buying or selling actions on that particular day is actually lower or very subdued. So whenever we see big green candles, we should basically, whenever we see big green candles, we should basically uh, consider a big green or a red, any color of candles. Whenever we see, we should assume that okay, institutional activity has been good on that day, and more number of buyers and sellers were involved on that day. And when the candles are very small in size, so on that day, on those days, you can assume, like these candles on those days, you can assume that the action was very low. So let us quickly begin with the first candlestick pattern. Before that, guys, I would ask everyone not to draw drawings on the board. And if you have already drawn, then kindly delete the drawings. So let us quickly start with the first candlestick pattern. So the first candlestick pattern is the Marubozu pattern. Marubozu pattern is nothing but a clear cut, clear red candle or a green candle. So uh, what happens in a Marubozu pattern is basically either on that day there has been only selling or only buying. So basically these candles, the body of the candle is completely full, and these candles do not have any upticks or downticks, which is also called the shadow of the candle. So these candles do not have any upper shadow or lower shadow. So like we discussed here, so this particular part of a candle, this particular part of the candle, the tip of the candle above this is called the upper shadow, and this is called the lower shadow. So in a Marubozu pattern, the upper shadow and lower shadow are basically not present, and only the body of the candle exists. So whenever this happen, imagine the ideology of the market participants. When it is a red candle, completely red candle, that means the opening price as well as the high price of that day are exactly equal, and the closing price as well as the lowest price of that day are exactly equal. Similarly, in case of buy candle, the opening price and lowest price are equal, and the selling price and the the highest price and the closing price are equal. So in this case, what we can think is basically here, if you see a red candle, a clear cut red candle with absolutely no upper or lower shadow with only body, this means that there has been only selling on that day, and market participants were ready to sell at any price, at any given price. The price didn't even return to the to the upper level. On that day there has been just selling. Similarly, in case of a blue or a green candle, uh, this indicates that market participants were ready to buy that particular stock or that particular currency or that particular script at whatever price people are offering. And by the end of the day, when market closed, people were just constantly buying and buying and buying. So this is the ideology. Like whenever this pattern occurs, it is almost like it is one of the like most sure shot patterns. And if this pattern occurs in a very good stock, then that means this trend is gonna continue on the next day as well. So if you see a candle, a complete red candle or a complete green candle, a Marubozu pattern on any chart, that means the same action, the same trend will gonna continue on the next day as well. So let us look at some examples on charts and see how these candlestick patterns can actually benefit. Okay, so let us first look at the example of a bullish Marubozu pattern. So here if we see, this particular is a clear cut Marubozu pattern. Yes, there is a slight lower shadow, but we can ignore this. If this difference is very small, then we can simply ignore this. So here we can see that this particular candle has occurred, and this indicates that market participants were ready to buy at whatever price people were offering, and they were ready to buy at every single price. So uh, the next day as well, this trend continued. Next day the prices opened here, they came a bit down, but then again on the next day the prices rallied. So this is an example of a bullish Marubozu. And see, Marubozu pattern is like, if you see this pattern in an FNO stock, then it is sure shot. It is almost sure shot that this trend will continue. the only thing is it is pretty difficult to identify Marubozu patterns because in live market it rarely happens. The sure shot type of scenario, it rarely happens. It happens only when there is a very big fundamental news or something like that, or very good results or something. So like ACC charts showed this pattern. This chart is roughly around 2012 time frame. So here you will see clearly the trend is continuing on the next day as well. Let us look at another example. Uh, so here, let us look at one example. Here again, we are seeing that Marubozu pattern is formed. We can ignore small bodies are there, upper shadow or lower shadow. We can ignore if it is almost negligible in comparison to the body. So we can ignore. So here, if we look into this trade setup, so as like by the time market is about to close, like around 3:20, 3:25 p.m., if you are seeing that there has been constant buying, then what you can do is you can basically uh, you can simply basically there are two types of possibilities. First is if you are a risk taker, a risk taking trader, then you can by the end of the day you can simply enter here and see what happened on the next day. The prices, the trend continued, and boom, the prices have rallied a lot, a lot. So this was an example of a Marubozu pattern wherein a risk taking trader can enter on the same day. Let's look at another example where a different type of trader, a pretty conservative trader, takes an entry into the market. And here we will, in this example, what we'll see is a conservative trader actually waits for the next day's opening. And as soon as the market opens, at that point he enters. So let us look at another example. So if we look into this example where of a conservative trade, so here we see that a clear-cut Marubozu pattern was formed here. Clear-cut bullish Marubozu pattern was formed, but a risk-taking trader, if a risk-taking trader would have entered here around the closing price of the same day, he would have faced losses. But a risk-averting trader, a conservative trader, clearly like he didn't even enter on the next day. So he didn't even enter on the next day and he avoided his losses. So this is like these were basically two examples on how you can take entry based on your risk appetite when you spot a Marubozu bullish Marubozu pattern. So like bullish Marubozu pattern, there is bearish Marubozu pattern as well. So before we discuss that, see basically let's also define what is the target and what is the stop loss in a Marubozu pattern. So in a Marubozu pattern, the stop loss is basically the lowest point of that day. So this point is the stop loss point. So the moment this price is hit, you have to exit the trade. And entry price is just above this candle. Entry price is just at the closing of this candle, just above the closing of this candle. And target is basically height of this candle. So in case of a Marubozu, target is also the height of the candle, and also if you are entering here, so stop loss is also exactly the same. So here the risk to reward ratio is basically 1:1. But since this is a very strong pattern, so most of the times if this occurs in a good quality stock, then you can, and the longer this candle is formed, the better indication this gives about the pattern. Now, similar to Marubozu pattern, bullish Marubozu, there is a bearish Marubozu pattern as well. So in a bearish Marubozu pattern, as discussed, it will be a long red candle and only selling has happened on that day. So when this happens, you see the selling pressure continued and the trend continued in the coming days as well. And see bazooka, it gave a good return. It gave good, like a lot of downside. It gave excellent downside. And just for your information, like this chart is basically from around the 1991 1992 levels. So this chart is from the time of Harshad Mehta. So you can see here clear cut, here bullish Marubozu is also present, again kind of bullish Marubozu, again bullish Marubozu. So here you will see very big candles, even up like longer blue candles as well as longer red candles. Every day there is institutional activity going on. And if you would have seen that series scam 1992, you would have seen how ACC chart, how ACC was very famous and like one of the favorite stocks of Harshad. So you can see clearly, you can see these candles, big candles, red and blue, red and blue. So he was consistently buying, selling, buying, selling. And this is evident in the charts as well. So if you recall, ACC was touching 350 and then 400, 420 ka highs in the charts. In if you recall the series, so this is how what happens. So now let us look at the trade setup of a Marubozu pattern, like of a bearish Marubozu pattern. So here again we will discuss from both the points of views. We'll discuss from both risky traders point of view and then conservative trader as well. So like the bullish Marubozu, again in the bearish Marubozu pattern, whenever this candlestick is formed on daily chart, the entry price is just near the closing price of this candle, and target is the height of this candle, and stop loss is the highest point, just opposite of the bullish Marubozu. So a risk-taking trader, by the end of the day, he would have created a short position. He would have sold the share and he would have created a short position here, and see how the trend continued beautifully in the coming days. And he would have bought back in huge profits, excellent profits. So this is how a risk-taking trader would have benefited here. Now let us look at another example where basically in like instead of a risk-taking trader, here in this example, what happens here is there is a clear-cut selling, but a risk-taking trader would have taken entry roughly around here only on the same day, and see the next day his stop loss would have hit on the next day or the next to next day. So basically, what happens here is in this particular example, we saw that a risk aversion trader or a conservative trader was actually able to like predict the market better, and he was able to actually avoid his losses because on the next day he didn't even enter. So we saw an example. So till now we saw one of the most strongest candlestick pattern, the bullish and bearish Marubozu patterns. These patterns are clear cut signs of trend continuation. These two candlestick patterns are signs of clear cut signs of trend continuation. So these patterns indicate how the trend will gonna continue in the coming days. But yes, again, you have to follow the risk and reward logics, which we discussed, because we again saw examples that in some cases the risk taking trader would have benefited, and in some cases the conservative trader wouldn't even have traded. So these were the two examples of the Marubozu pattern. Now we will move to guys, I'll ask you all to keep your audios on mute. Uh, and so, in case of a Marubozu pattern, see, we saw that both the cases were possible. Sometimes a risk-taking trader was benefiting, and sometimes the risk taking trader was kind of making losses. So, and in those cases, the conservative traders smartly avoided entry into the trade. So, from this, we clearly understand that a Marubozu pattern can also be a trade trap. A bearish or a bullish trap can be laid by the market participants. So how to identify? So what we have to do is one should actually avoid trading if the length of the candle is less than 1% of the price of the script. I mean, which if the candle size is very low, if the candle size is very, very low, then there is no point of trading on that day, because even if a Marubozu pattern is formed, it is not formed because of intense buying selling action. It is formed because of just small trading action. So that does not have much significance. And similarly, if the length of the candle is more than 10% of the price of the script, then again, you should actually avoid those trades, because in this case, your stop loss will be very deep. And in case the stop loss hits, you will be like, it will be very painful for you. So as per the risk management logics, in case uh, a Marubozu pattern you find, and in case the script moves more than 10%, upper circuit hit hona type, those types of things, if these things happen, then you should actually avoid those trades. There are many people who come to me and ask about stocks like Future Retail, and earlier there was Alok Industries, Ruchi Soya. Many companies are there, Vakrangi and all. You will find these stocks. The stocks of these like charts of these stocks are filled with Marubozu patterns, bullish or bearish. You will find circuits getting hit every single day. Circuits are getting hit, and just we clearly discussed that if the price of the script is more than 10% of the script, and in some cases if the circuit limit is 5% only, so you should actually avoid based on this risk management logic. So there are many people, many of you have confusions, and many of you come up with me to me with these doubts, saying that this particular stock is hitting circuit every day. Like, should I buy or not? Or I have been holding this stock and it is falling and it is hitting lower circuit every day. What should I do? So clearly, you should understand that like, you should not actually enter into that type of trade based on the risk management logic. So now you know at least how, which stocks to avoid. If you are seeing a stock which has everyday Marubozu patterns or very frequent Marubozu patterns, then you should definitely avoid those stocks. Now let us move to the other candlestick pattern, which is actually one of the most important patterns when you combine this with other technical analysis tools actually. And you'll find this pattern occurring very frequently on daily chart, on 5-minute chart, on 15-minute chart, on various intervals of chart. You'll find this particular pattern occurring very frequently. So this particular pattern is called the spinning top pattern. And as the name suggests, uh, the spinning top pattern is again it is again exactly the same type of here what happens is that the body of the candle is very small, and it has a big upper shadow as well as a big lower shadow. In case of a bullish spinning top, the opening the candle is a green candle, and the opening price is here, and the closing price is just above it. So let us first look at the ideology of the market participants. See, in case of Marubozu pattern, we saw that market participants were, in case of a bullish Marubozu, they were ready to buy at whatever price market is offering. They were ready to buy due to some good results, some good news in the sector, finance minister announcing some good thing for banks, or any good news. So you will frequently find like those types of patterns occurring on events basically. In case of a spinning top, the ideology of market participants, let's try to understand the ideology. So in order to understand the ideology, we will break this candle into two parts. The first part will be the top half, and then second part will be the bottom half. So let us first analyze the top half. So in the top half, what we see here is, in the top half, we see that prices opened here, and then it went very high, and but again it came down. Okay, prices opened, it went very high, but again it closed almost near to the opening price. It closed almost near to the opening price. So what does this mean? This means that bulls took the entry. They were ready, they were actually able to take the prices upwards, but suddenly excuse me yeah, but suddenly when the prices reached to a certain point, suddenly like this prices seemed very high to the bears, and bears took entry into the market, and bears again forced the prices to come down. So this indicates that though the bulls were very active, but they were not able to sustain their strength. Either they got tired, or they lost their entire capacity, or bears made fresh entry into the market. So this can be anything, either of the three. So but the overall result is that bulls were not able to take the prices upwards. So, this happened in the top part. Now let us analyze the bottom half. In the bottom half, you will see that bears tried to take the prices down, but suddenly after reaching certain point, these prices seemed very attractive, and bulls made fresh entry, and bulls pushed the prices upwards. So if we look at the entire candle, if we like collect both the bottom and top halves, we are seeing that both the bulls as well as bears tried to, like, they had a very intense battle on the entire day. They had a very intense battle, and none of them turned out to be a clear winner, because the opening and closing prices are almost the same. It is very close. And the longer, see, the closer these opening closing prices are, and the longer these upper shadow and lower shadows of the candle are, that means more intense buying selling action happen on that day. Bulls tried to take the prices upwards, but they couldn't. Bears tried to take the prices downwards, but they also couldn't. And none of the participants were none of these people were clear cut winners. Similarly, in case of a red candle, again, see, body of the candle does not matter when the candle is very short. either it is a green or red, it does not matter, because opening price, if opening closing prices are almost the same, it does not matter at all. So in both the cases, we are seeing that there is a big, huge struggle between the bulls and the bears. And now let us look what happens. So here, like ideology wise, neither the bulls won, neither the bears won. So what does this indicate? This indicates uncertainty in the market. Like people are not sure whether the prices, like whether the market will go up or whether market will go down, whether this script or whether this stock, whether this currency or commodity, whatever the thing we are analyzing, whether it will go up or down, we are not sure. So whenever you spot a spinning top, you should be like, you should know that there is uncertainty in the market. So now let us look how spinning tops behave in different types of like market scenarios. So let us see, there is a downtrend. Let us suppose there is a downtrend in the market. Okay, let us see from here to here, prices are coming down. So it is a downtrend. After a downtrend, see here, spinning tops are occurring. One spinning top, second, third, two, like two spinning tops are occurring in batch. So what does this indicate? This indicates uncertainty. Okay. So in a downtrend, we saw that what happens here is market participants were uncertain at this point of time. They were uncertain, and what happened? See, there are continuously, if you'll see now from here to here, it is kind of a spinning top only overall. So over a long period of time, what happened was market participants were consolidating their positions. The bears who were like very strong till this downtrend was occurring, they suddenly lost their strength, and bulls made fresh entry, and they were buying stocks in a staggered manner. They were buying stocks in a staggered manner. And this, whenever I say, like in my recommendations, whenever I say buy in a staggered manner, most of the times I mean this particular thing. Market participants are buying in a staggered manner, and they are not sure. And see what happened. This downtrend was followed up by an uptrend, means trend reversal was there. So we clearly saw that in a downtrend, the spinning top, when the spinning top occurred, like there is a clear cut trend reversal for a long period of time. For these many days, there was consolidation, and there is huge trend reversal, huge reversal. Now let us look at other example. See, in this case, what happens is, this is a downtrend, then there is consolidation, there are spinning tops. So there is consolidation, and then this consolidation is again followed by another downtrend. So in previous example, we saw that when a spinning top occurred, uh, this means uncertainty in the market. So market participants are not sure whether the prices will go down or up. So in some cases, in this case, bulls made fresh entry, and it was a trend reversal. In this case, what is happening is bears are just consolidating their position. They are just taking a breather, and then they are uh, starting in next gear. And uh, like the trend is continuing. See here, you can clearly see the trend getting continued. So we saw that in a spinning top, both the cases are possible. Now let us discuss, let us see some, look at some more examples. So here, here again, if you see, sorry, here again, if you see, what happens is there is an uptrend, and this uptrend is followed by certain spinning tops. Okay. And after the spinning tops were spotted, market was consolidating for a certain point of time. Basically, from here to here, this entire time market was consolidating here to here. Entire time it was consolidating, and suddenly, after certain point of time, after consolidation, after these uncertainties, market actually rallied. And here again, in an uptrend, we are seeing trend continuation in case of a spinning top. So like we saw till now, we saw that spinning top indicates uncertainty, and whenever this happens, there are two possibilities. Either like in case of an uptrend, either the bulls are consolidating their position, or they have lost their strength. If they are consolidating their position, then that means that the trend is going to continue. And if they have lost their strength, that means the trend is going to come down. Now, how to whenever these how to spot what action to take, I'll cover that in the next upcoming slides. So here till now we saw that in both in case of uptrend as well as downtrend, whenever spinning tops occur, they are occurring in batches over long period of time, and either there is either there is trend continuation, downtrend, uptrend, or there is trend reversal. So here also trend reversal. Now, let us look at another modified version of spinning top, which is another candlestick. This is basically the doji candlestick. In doji, it is just like a spinning top. The thing is, like in this particular candle, the opening and closing prices are almost the same. It is like the most ideal case of spinning top. A doji is like the most ideal case of a spinning top. And so in case of whenever you see a doji occurring, again, the ideology for buyers and sellers is that neither the bulls, neither the bears were clear cut winner on this particular day. So this means consolidation. They are consolidating their positions, and there is uncertainty in the market. So now let us see what see here we I'm actually continuing the example of spinning top and doji. Both are kind of same patterns only. So here what we see is, see, doji patterns or spinning top, see, you can call it doji or spinning top, it is kind of same only. So doji, when this doji pattern is occurring in a downtrend, see, this showed some consolidation, and it is follow, and the market was getting ready. There is indecision in the market, but the market was actually getting ready for the next big move in this example. Now let us look at one more example. See, in this example, there is a very healthy uptrend, and then we are seeing spinning tops and dojis occurring here. And see, this has caused a big correction. Again, there was uncertainty, and after this uncertainty, there is big correction in the market. So one thing is very clear. The next time you see a spinning top or doji occurring individually or in clusters, just remember that there is indecision in the market. The market can go up as well as down. So how to enter or how to take advantage of this situation? So first thing is, let's suppose you want to buy 100 shares of a company. So instead of buying 100 shares, you know that there is uncertainty. So instead of buying 100 shares, what you can do is, first is you can buy just 50 shares. So in this way, what you are doing is you are not neither losing the opportunity, neither are you. Let's suppose you want to buy a particular stock. Let's suppose you want to buy this particular stock. So this stock is falling, falling, falling. Every day it is falling, and you want to buy the stock. Let's suppose your advisor or somebody has suggested buy on dips. So the stock is continuously falling every day. The moment you start seeing doji patterns or spinning tops occurring in clusters, that means that this is the time to enter now. So start entering in a staggered manner. Instead of like suppose if you have plans to buy 100 shares, so buy 10 shares, 20 shares, 30 shares, like in batches, 10 shares per day or 20 shares per day. Buy up to 50, 60 shares, buy up to 50% of the amount, and keep the remaining amount side, like on the side, so that in case this trend continues, in case this downtrend continues, you are again able to buy at lower levels. So doji or spinning top candles are basically used to enter markets on dips. Basically, these indicate uncertainty, means a clear cut bear strength or a clear cut bullish strength is lost. So these these patterns are used to basically enter into the markets for longer time frame if you are entering into a staggered manner. So this is a good way. Similarly, like if you are already holding a stock and if you are seeing dojis occurring simultaneously, dojis or spinning tops, then this means that like there is uncertainty in the market, which means that if you are buying the stock, if you are holding the stock for a short term, if you traded here, so what you can do is you can book partial profits. You can sell half the stocks and book partial profits. So what will happen in this case is, this means that, see, whenever there is uncertainty, that means just before uncertainty, there must have been bullishness or bearishness. Otherwise, that point would also have been uncertain. So the moment uncertainty starts, that means either the bull or the bear who was moving the prices is now either consolidating his or her position, like their position, or they have lost their strength. So they can like a next move can occur in the same direction as well as opposite direction. But again, uh, this gives you a chance to buy in a staggered manner. And similarly, let's suppose if you are holding a stock, this again gives you a chance to book profits in a staggered manner, or book partial profits, and hold the other quantity with the entry price as stop loss and multiple. So these patterns are basically used to enter the markets. So this is how these patterns are basically traded, mostly from an investor's point of view. This pattern is mainly important. The previous pattern was important from a trader's point of view. So this is clear. Now let us look at another important pattern, which is called the paper umbrella. But I actually call it Thor's hammer. Everybody like on the group, I have mentioned this Thor's hammer pattern. So it is like, as the name suggests, it looks like an umbrella or a hammer, like like Thor's hammer. So what happens here is, let us look at the ideology in this particular uh, whenever you spot this particular candlestick, let us look at the ideology of the market participant. So just like the spinning top, it is just like half part of the spinning top, right? It is exactly like half part of the spinning top. So here what we see is, prices opened here, prices closed here, it is almost same. But in the meanwhile, in the entire day, what happened was, bears tried to take the prices down, but they were not able to do that. So bears tried to take the prices down, but they were not able to do so. Whether it is a bullish, like a blue candle or green candle, or it is a red candle, it does not matter. What matters is, because the size is almost, opening and closing price is almost same, so it does not matter much. What matters here is the longer this shadow, the longer this line, the more stronger this pattern is. And what does this pattern indicates is, bears tried to take the prices down, but they were not able to take the prices down. So that means bears clearly lost their strength in this particular on this particular trading day. Now let us look at what happens when this particular candlestick occurs in a chart. Clearly clearly if this candlestick pattern occurs in a downtrend, if this candlestick pattern occurs, let's see here, this is a downtrend. So if clearly this candlestick pattern occurs in a downtrend, this means that suddenly the bears have lost their strength. So when bears have lost, so either bears have lost their strength, or more bulls have taken fresh entry into the market and they are beating the bears. So whenever you see this pattern in a downtrend, it is like very clear sign of trend reversal. It shows that the trend is gonna reverse. See here, downtrend, then Thor's hammer is formed. Bears tried to take the prices down, but then bulls took fresh entry and they pushed the prices up, and the bears have lost all their strength. And see what happened. Prices rallied. Similarly, again in the same chart, again you will find again this downtrend is followed by a hammer. So again in this hammer pattern, bulls took fresh entry, and see again the stock prices rallied. So whenever you spot Thor's hammer, this particular pattern in a downtrend, it is clear cut sign of trend reversal. Clear cut sign of trend reversal. And in this case, the stop loss is the lower point, lowest point of this candle. So stop loss would be the lowest point of this candle, and entry would be just above the highest point of this candle. So this is how you operate in this candle. Let us look at few more examples when this candle occurs. So let us look at this Thor's hammer formation, and let us see how a risky trader would have benefited. So this is a downtrend. This is a nosedive type of downtrend. This type of downtrend occurs during pandemic-like situations, or when there is very bad news for a stock or a sector or something. So this particular downtrend occurred, and see, this downtrend is followed by a Thor's hammer. It is a long body, clear long body. This is followed by one Thor's hammer, two Thor's hammer, and three. There are three Thor's hammers formed here. And this indicated that on all the 3 days, bears tried to take the prices down, but they didn't win the battle. Bulls pushed the prices back to where it started. And see what is happening. Either they push the prices to where it started, or even higher, and see how the trend is reversing. So the downtrend was followed by a trend reversal. And in this case, the risky trader would have actually entered around like around when the day is about to end, around at 3:20, 3:25, 3:28 p.m. Roughly around that time, he would have entered and he would have made huge profits. See. So now let us look at one more example uh, where what is happening. This downtrend is like there is a clear-cut horse hammer, but a risk-taking trader would have entered on the same day and see his stop loss would have hit. And in this case, again, the conservative trader didn't even have, like, he wouldn't even have traded, because in order to enter into this position, you have to enter above the closing price, just above the closing price, highest point, just above the highest price of this candle. So in this case, again, like conservative trader was again able to protect himself from his losses. So, uh, like we saw again examples of this Thor's hammer formation in case of a downtrend. In case of a downtrend, like let us look at one more example. So here in this example, what is happening? Both Thor's hammer and doji are occurring. So first doji is occurring, which is indicating uncertainty, and then Thor's hammer is occurring. But again, like a risk-taking trader would have entered on the same day, but again, a conservative trader wouldn't even have entered, and he wouldn't. And again, a conservative trader won because he wouldn't have entered a trade, and his stop losses wouldn't have hit. But a risky trader would have entered this trade. So again, like conservative trader is beating here the risky trader. So till now, whatever candlestick patterns we have discussed, we are seeing that, okay, you can take entry on the same day as well, or on the next day. There are other things as well, which we'll study like as this course progresses. But till now, we are seeing that, okay, as a conservative trader, it is like pretty much safer to enter into these candlestick patterns. Now let us look at this hammer formation is there. Like this hammer looks pretty much evident when this is occurring in a downtrend. But now let us look at uh, one more example. In this example, this particular hammer is occurring, it is not occurring in a downtrend, it is occurring in a sideways trend. See, market was sideways and then this particular trend occurred. So since this is a trend reversal type of thing, and this was like there was no clear cut trend, which means that bulls and bears were equally strong. Bulls and bears were equally strong on all these days. So if on this particular day, if bears didn't show a lot of strength, then this does not mean that they do not have the strength. They have been showing the strength since these many days. So we wouldn't have even entered into this trade. So in order to, like, one thing is, make sure one thing is very clear, guys. In case of this hammer formation, you have to enter only when this is occurring in a downtrend, not in a sideways trend. Only when this is occurring in a downtrend. Now let us look at one more candlestick formation, which is called as the hanging man. Hanging man is exactly like the Thor's hammer. The thing is, it's called hanging man because it looks like a hanging man, and Thor's hammer also looks exactly the same. The point is, when this particular candlestick pattern occurs in an uptrend, it looks like somebody is hanging. So that is why it is called a hanging man. And when the same pattern occurs in a downtrend, it is called a Thor's hammer. So pattern wise, it is exactly the same. We have just given two different names, so that if somebody says hanging man, then it means that it is like an uptrend was there, and if somebody says uh, Thor's hammer, then it means that it was followed by a downtrend. So again, here we are seeing that the bulls are clearly strong on all these days. Bulls are taking the prices upwards, and see, suddenly what happens is, on this particular day, what happens is, the ideology of hanging man is a little different from ideology of Thor's hammer. Here what happens is that on all these days, bears didn't even had the strength to beat the bulls. Like on any day, they were not even able to beat the bulls. But on this particular day, see, bears were considerably able to challenge the bulls. So the bulls who had all the strength in this uptrend before this pattern occurred, bulls were very strong. And see, suddenly when this pattern occurs, that means bears are so strong that on this particular day, the bears are able to beat the bulls for even though for a shorter period of time, and prices are actually closing at the like near opening price only. So this means that on this particular day, bulls and bears were like almost equal, like their strength was almost equal. And since this is followed by an uptrend, so this means that since every day bulls were taking the prices upwards, now today suddenly bulls are not able to take the prices upwards. That means that fresh bears have taken entry into the market. Bears have taken entry into the market, and see what is happening. This uh, again, this hanging man indicates a trend reversal, just like a Thor's hammer. So again, it is exactly the opposite logic. It is exactly opposite like, logic. So here again, this is followed by a trend reversal, this hanging man formation. Now, in a hanging man formation, let us look at the entry and stop loss prices, just like the Thor's hammer formation. So entry and stop loss prices would be, the entry would be just below the like lowest point of the candle, and stop loss would be at the exact like just above the highest point of the candle. So here on this next day, what would have happened is basically the risk basically the risk taking trader, sorry, conservative trader would have entered just below this line. So he would have entered when the prices reached here, and see how the beautifully prices went down. And see again, when the prices went down, this is a downtrend. Now see big Thor's hammer. So obviously after like if you look at this chart, obviously it has signs. These are signs that the next chart that will be formed, see here clearly, bulls have suddenly gained entry, just like in this pattern, just like here in an uptrend when bulls were strong, and suddenly when this sorry, hanging man occurs, this means that bears have suddenly, new bears have come into the market. Similarly here in a downtrend, when Thor's hammer occurs, this means that fresh bulls have entered into the market. Otherwise this would have been a red candle, prices would have moved down. So since that didn't happen, then this means that new bulls have come into the market. Okay. So these were two patterns. Now let us look at one more alteration of this Thor's hammer, which is called the shooting star. So shooting star, as the name suggests, it looks like a shooting star. It is exactly the mirror image of the Thor's hammer. So it is exactly the mirror image of the Thor's hammer pattern. And here again, the ideology is bulls were like in an uptrend, bulls were very powerful. They were trying to take the prices up, like up. On this particular day as well, bulls tried to take the prices up, but they were not successful. Fresh bears entered into the market and brought the prices down. So till yesterday, the bulls who were like very strong, and every day they were able to take the prices up, suddenly these bulls have lost strength. Like suddenly fresh bears have entered into the market, and see what happens. This is again followed by a trend reversal. So shooting star, hanging man, Thor's hammer, these patterns are example signs of trend reversal. Signs of trend reversal. A spinning top or a doji is can be trend reversal or trend continuation, but it indicates uncertainty. So for long-term investor wise, what happens when these patterns occur? When shooting star or doji occurs, it is for investor wise, it is like it indicates that you can take fresh entry partially, or you can book for partial profits. In case of shooting star or a hammer or a hanging man, this indicates mainly trend reversal. So this is again beneficial for the trader as well as investor. This pattern can be used both to book losses or to take fresh positions into the market. Now let us see shooting star in an uptrend. See, like in the previous example, again in this example, shooting, there is an uptrend and there is shooting star. So this means that bulls were strong. Every day they were taking the prices up. But on this day, suddenly bulls lost their strength because fresh bears stepped into the market and they brought the prices down. And see how beautifully the prices continued. Like this trend was reversed just soon as the shooting star was spotted, trend reversed, and uptrend was changed into a downtrend. Here again, you will see that the price kind of touched stop loss, near to stop loss, and again the trend reversed. So shooting stars are signs of trend reversal. Shooting stars, hanging man, hammers, these are signs of trend reversal. Now let us look at one more example. In this, why I'm showing all these examples is that so that you can like get more grasp and like you are able to identify these patterns more beautifully. So here again, here if you'll see that in an uptrend, shooting star occurred, but see here stop loss is hit into in this particular example, stop loss is hit, even though here in this example, stop loss is hit for both the risk taking trader as well as the conservative trader. Both the traders like stop loss is hit. So although these patterns are signs of trend reversal, but I have also shown, like with every pattern, I have also shown the stop loss hit case, so that you can like you can get to know, and you have this feeling that none of these patterns are 100% signals. You just get prediction. You can use these patterns along with other like advanced topics which we'll discuss in technical analysis. But the thing is, you can use these patterns to take some judgments into the markets, and you have now some like some concepts ki, okay, how will the prices move in the coming days. So most of the times, if you use these single candlestick patterns along with other like multiple candlestick patterns or trend lines, then you will be able to take like very profitable trades. So till now I have shown multiple examples, and guys, if you have any questions, keep like simply ping that question in the chat, and like I'll try to answer all those questions. Now like if anybody has any questions, you can simply ping in the chat and I'll try to answer these questions. Till now, why I have showed you stop loss cases, because as a trader, it is very important to maintain strict stop losses. Otherwise, you will actually like you will end up losing all your capital, or you will end up holding on to your losing stock for way longer time, and then like you will. This is the one of the beginners' mistake. People actually, when a stock rallies, people say that whenever, like as soon as I bought the stock, it went like as soon as I bought the stock, it started to fall down, and as soon as I sold the stock, it went up. So at least now you have some idea that before buying or selling, you can at least try to look for these things ki, acha, is there uncertainty, is there some pattern. At least you'll find that these spinning tops or dojis, they are occurring like very frequently, and whenever those things occur, you like you get an idea that okay, how to proceed in the market. Now like before we end the session, as we discussed, like this is actually all from this session from technical analysis point of view, but before we end the session, I would like to, like as we discussed, I will share an important story, like a very interesting story, a story which is too good to be true. It is kind of that particular, when I'll show you the story, when I'll share the story, it will be like a fairy tale, a magical kind of story. People actually, many people don't even dream up to like this level. So this story involves a person named George Soros. He said that I'm only rich because I know when I'm wrong. That means he's following strict stop losses. I basically have survived by recognizing my mistakes. He's saying that like he is so rich, like he is rich just because he knew when he was wrong. He knew when to exit the trade. So till now, for all these patterns, I have told you clearly like where will be the stop losses, how to enter. So whenever stop losses hit, do not challenge the market or do not think that okay, this thing will happen. Simply exit. Because like see, this person, many of you might not know him, but he is regarded as one of the greatest traders the world has ever seen. So George Soros, let me like tell his story by sharing an image. So George Soros, he is basically recognized as the man who broke the Bank of England. If you Google about this person, George Soros, you'll find that he is given this title as the man who broke the Bank of England. So we'll see this interesting trade story. So basically, what happened was George Soros shorted the British pound and he made the entire Bank of England bleed. He shorted the British pound and he made the entire Bank of England bleed. And basically, when by the time he exited his trade, Like many things have happened, many things happened in the market. The prime minister of England had to resign. New prime minister was elected, ruling party was gone, pound was out of the uh, pound was out of the ERM model. ERM model is basically the interest rate management, European interest rate management model. So out of this ERM model, pound was dropped. Now, to many of you, who are not able to, like, if you are not able to understand the seriousness of this situation, let me first tell you the date when this happened. This happened on 16th September 1992. Uh, which is also regarded as the Black Wednesday. And if you'll see the movie Wolf of Wall Street, there also this Black Wednesday is like this particular day is denoted. And let me tell you the beautiful story of how this trade occurred. So, George Soros, basically before this trade, what happened was George Soros was a hedge fund manager, and his fund name was Quantum Fund. So before this occurred, before happened, what happened was in the entire Europe, there were different currencies like euro came into the picture in 1998. But in the entire, like before that point of time in 1970s, what happened was basically an ERM model was launched by all the European countries. So what happened was during that time there were different currencies like Germany had the franc, Swiss has the like different pounds, sterling. All these currencies were circulating in the market, and different. What happened was Europe is Europe is a continent which is actually divided into a lot of small countries. And in the past, what had happened was many invaders, they had invaded many countries, and these countries actually they thought that, like, by the fear of losing everything to war, what they did was they thought that let's come into an agreement, let's form some agreement. So what will happen is that based on that agreement we'll develop more friendly relations, as well as we will come together, so that in case of some war like situation, in case some big country tries to invade us, we will get protected. So what happened was this ERM model was launched. The European interest rate management model was launched. And in that model, what happened was all the countries of Europe agreed, except Britain, except UK. All the countries of of Europe, like they agreed that what they will do is uh, they will follow a specific interest rate management model. And what will happen is that at every point of time, let's suppose if a particular currency um, uh, of a country starts to rise or fall, the central bank of that country will step in and try to bring back the value of the currency to the like actual level. Let's suppose if the economy is falling, so like if economy is falling, currency is weakening, so the central bank will basically like lower down the interest rate, like RBI is lowering down the interest rate when GDP is falling. So when this happens, so basically what they came into an agreement that whenever a currency falls, the central bank will basically step in and artificially try to, what they will do is artificially, let's suppose if the currency is falling, they will artificially buy back the currency from the open market, and thus creating a demand for the currency, and the currency will move back to the original level. Similarly, if the currency is rising, they will again either they will change the interest rates, or they will sell the currencies notes in open market, and then they will again bring back the currency to their level. So what happens was by the like using this mainly, like at every point of time a balance was maintained. Okay, one a balance was maintained. Okay, one German franc was always equal to roughly, okay, only this much sterling, or only this much francs, or only this much. So in all the countries everything was kind of fixed. What happened was during that time, during the 1980 to 1990 era, uh, Prime Minister of England was Margaret Thatcher, and she was basically at that point England, like she was of this thought that this ERM model is not beneficial for England, because England is a superpower. It is a very big powerful country. It is the it is among the top 5 economies of the world. So we should not enter this model, because since we are big country, so chances of us like weakening are very low. And like if we enter into this agreement, then like at any point of time, if we are growing much, then as per this agreement we will have to sell or weaken our currency or lower the interest rates. So like this was her thought, and due to this she was opposing, and Britain was not the part of uh, this ERM model. Then by the end of late 1980s, and by the time of 1990, in the year 1990 basically, what happened was, by that time Britain's economy was collapsing. Economy was falling so much so, and the currency was weakening a lot. And what happened was, by that time, like since this like all these things happened, the opposition parties, like in our times opposition parties are there. So opposition party leader John Mayer, his name was John Mayer, he basically like proposed that like if he gets elected, then he will force England, like he will basically allow England to enter into this ERM model, and thus all the other countries will have to change their interest rates, or they will have to support the currency of England, so that basically what will happen is that, and in that case, in this way, economy of England will be controlled. So this was his thought, and what happened was he basically won the elections in 1990, and Margaret Thatcher was lost the elections. And in 1990, Britain entered this ERM model, and as soon as Britain entered into the CRM model, what happened was, since economy was falling, so as per the model, Britain had to lower down the interest rate as well as buy back pound from the like open market to inflate its value, so that the standards are met. But 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 here the important point to note was, Britain's economy had already collapsed a lot, and this was artificially inflation. Like here, artificially people like basically the central bank of Britain had to artificially inflate the value of pound. So at this point, George Soros and his fund, like he spotted this as an opportunity, and by the start of September 1992, by the start of September 1992, like basically from 2nd September 1992, he began selling. What he did was, he began buying the German franc, which was very powerful at that point of time, just because in 1990 one more important event happened, that was the unification of Germany. West Germany and East Germany unified. And like if you recall, if anybody is a fan of football, you will recall when Mario Götze like scored that goal in the final. Commentators said that first time since the unification of Germany, German a player from West Germany has scored a goal, and which has actually because actually after the unification of Germany, all Germany became East Germany. So what happened was, at in this particular point, uh, Germany like Germany united in the same time, like when elections were won. And what happened was that Germany became a very big superpower. So George Soros, what he did was, what he simply did was, he simply sold pounds. He took like all the money he was able to take from markets, from everywhere, from all the people, from everywhere, all the money which he was able to take from the markets, he took the markets, he sold British pound, and he bought German francs. So what his ideology was, like he thought that since the central bank of Britain is actually artificially inflating the prices, and the economy has fallen so much so that this artificial inflation will fall, definitely fall. All the speculators, every day in the news there was that the like this pound will fall. The only problem was, people didn't knew when the pound will fall. Just like nowadays Bitcoin and all these bubbles are there, people know that yes, the bubble will burst, but they don't know when it will burst. So George Soros, what he did was, he actually saw this as an opportunity, and he bought money from all over the world. He had a very big hedge fund at that time. The fund name was Quantum Fund, and he basically started shorting the pound. And what happened was, basically every day he sorted pounds, and by the time, like by 12th September 1992 night time, basically George Soros at that time he was operating from New York office. So at there it was daytime, and in London it was basically like early morning, 5 a.m., 6 a.m., at something around that point of time. And in Germany, like basically the in Germany basically markets open. Basically in London it was around 8:30, somewhere around that time, and in Germany basically markets open. So there was one German analyst, I am not able to recall his name. He was basically, what he said was that uh, he said that one or two major currencies of the world look very weak now, which look very artificially inflated, and it is time that like that currency may collapse. And he was actually the vice chancellor of Germany at that point of time. So this statement from this chancellor acted as a blessing in disguise for George Soros. And within basically within 1 to 1.5 hours of the statement was made, uh, basically there was a strong high level meeting between the Prime Minister of Britain and all the ministers. And what they did was, in order to curb this situation, in order to like by this time George Soros had already shorted around 15 billion worth of pounds, $15 billion worth of pounds at that point of time. $15 billion worth of pounds he had already shorted. And what happened was, in the meeting with the Prime Minister, what they decided was to increase the interest rate drastically, so that this can be like this move could be countered. So from 10% they increased the interest rate to 12%, like within instantly. This is a huge increase. But again, George Soros, he had already shorted a lot of funds, a lot of currency notes. And what he did was, he like when this news came, this news acted as a blessing in disguise, and all other fund managers across the world and retail traders, everybody started shorting the pound, because everybody knew that this thing was artificially inflated and this will come down. So everybody started shorting. And by the time the Prime Minister announced 12% interest rate, at that point of time 15 billion worth of pounds worth of dollars, George Soros money and other money into the market, like basically $27 billion worth of pounds were shorted. Billion dollars worth of pounds were shorted. If you are not able to like grasp what is this, so $27 billion is actually the entire year's tax collection of many European countries at that point of time. So it was a very big amount. This much was shorted. And when the Prime Minister announced basically 2% hike in interest rate, so the prices corrected, but the correction was just merely $1 billion worth. Matlab, the strength of that correction was like very low. Then again, immediately they had another meeting, and instantly within 2 hours, they again announced that the interest rates will increase from 12% to 15%. And see, in a day, interest rate basically increased by 50%, from 10 to 15%. This this was a lot. But by this time all these moves had happened. By this time all these moves had happened. Basically, like pound dropped so much so that it was virtually impossible. Like even if Britain put all its money from treasury and everywhere, even if Britain had to put its money, then also they wouldn't have been able to square off to counter this position. So the Prime Minister instantly announced that he will be exiting the ERM model, the European interest rate management model. They announced that Britain will be exiting within 2 years, and it was a political suicide for him. Like nobody could have announced this, but like he tried to take all the measures. But again, like he basically announced this, that Britain will be exiting. So this particular person, this man, he basically like he and his hedge fund has basically beaten down the entire government of England, entire Bank of England, which was countering it. And in this process, basically in this process, he had made like his hedge fund shot up from 15 billion to 19 billion worth. Basically this much was the increase in the profits of the hedge fund. And at that point the profits commission was basically 20% of profit sharing. So he basically made 1.4 billion dollars, $1.4 billion, which was more than the entire year's tax collection of many European countries at that point of time. And see, like in trade, a trader's loss, like one person's profit is someone else's gains, are someone else's losses. So in this case, like basically the entire losses were basically from the Bank of England, which is basically the taxpayers' money of English people. And like due to this reason, like after this, there were many other things. Even the current Brexit thing, which is happening, it is again like same thing. Basically, like since this hedge like these events occurred, since then Britain has been very careful. Like in 1998, euro was launched, and multiple regulations have come into the picture so that like these events cannot occur in future. But the thing is, like this particular man within a short span of 11 days made $1.4 billion in 1992. At that point of time, he made the entire economy of a like entire nation crash and crumble. So like this was the story. Like this is kind of a fairy tale. If you also in your wildest dreams imagine of some profits, it will be crores or something. You will never imagine that you are beating the RBI of India or some like entire bank or entire institution. You are beating the entire country or government. So like basically this is what happened in this like. So this man was so great, and if he is saying that I'm only rich because I know when I'm wrong, and I've basically survived by recognizing my mistakes. So that means if he is following strict stop losses, the man who broke the Bank of England, if he's following strict stop losses, then we should also follow strict stop losses in all candlestick patterns. And guys, this was just the first part of the entire course. We'll be covering basics of technical analysis in our entire module. Where we'll be like the next session will involve multiple candlestick patterns, like two or three different candlestick patterns occurring in a particular pattern, and then we'll discuss trend lines, charting patterns, and we'll also discuss the demand supply theory. And we'll also by the end of this course, basically you will be able to make successful day trading, like you will be able to spot successful day trading ideas on your own. So the cost of this course is just 24.99 plus GST. And thank you so much everyone who has been attending this session. You have been a lovely audience. Please do follow us on our Facebook, Instagram, and YouTube channel. You can search us by the name Orchid Research. Thank you so much, guys. You have been a wonderful audience. Home, stay safe, and take care. Bye bye. A recording of the session will be available on the YouTube channel by evening, and I'll be sharing. Thank you, guys. Take care. Bye bye.